and gentlemen, welcome back to Strongman Personal Finance. Whee! That's right, ladies and gentlemen. Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. Go buy it. I need your money. And I'm going to do a special video today since I'm on paternity leave. Sadly, I have to go back to work on Thursday because I have a job like a loser. But in this video, I want to take the audience's suggestions. So go ahead, drop whatever stock you want me to look at in the comments, and I will go on stockanalysis.com and try to give the stock some kind of valuation. Now, keep in mind, ladies and gentlemen, most of these companies I'm not going to know crap about. Jack crap. Okay, I don't want to curse too early in the video so I don't get demonetized. Oh my God. But I don't know jack about them. Now, if I come up with some kind of valuation, that doesn't mean it's a buy or not. Okay, you need to do your own freaking research. So we're going to do some stocks. So, we got a couple ones already. OMG stock, or is that an OMG? Echo Wave Power. Is that a real thing? Let's go look. Are you screwing with me? Echo Wave. Oh, it is not. Wave my chief. Let's go look. Okay, so we got Echo Wave Power. I'm going to pull this up. And we're going to look at the financials. The financial statements like a financial advisor. Okay. Echo Wave Power Global. Blah, 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 blah. All right. It's got a $24 million market cap. What is this? Okay. That's like a micro cap. Revenue, is that $31,000? I make more than that. Christopher Belly makes more than that. Net income. I hope you make more than that too. Net income, negative $235 million. So they basically lost almost as much as they brought in revenue. That's amazing. Okay. So Echo Wave Power Global, a wave energy company, engages in the development of a wave energy conversion technology that converts ocean and sea waves into clean electricity. That's interesting. That is interesting. It operates a grid-connected wave energy array in Gibraltar. Isn't that like Germany or something? No, it's on the tip of Spain. Under a power purchase agreement with the government of Gibraltar. So let's go look up this company. I was going to do Outlet if nobody gave suggestions, but we already have one. Echo Wave Power Global. Let's go ahead and check this out. Now, I want to get a feel for the company. I want to get a feel for their website. I always judge them based on their website. Changing the world one wave at a time. Okay. I see some. Oh, I thought they were boats. Those look like boats. Okay. So basically, the waves move the boats. So that generates electricity. That's really interesting, but of course, it's highly speculative. And I can't really tell you anything about the technology. I have no idea. So they have a project in Israel. You mad, Mike? Gibraltar. And what do they got for future projects? This is actually really interesting. Financially, it's garbage, but it's an interesting concept. They have a significant projects pipeline of more than 325 megawatts. Is that what that means? Okay, this is where it gets complicated. It's seeking to provide to additional that are suitable for wave energy, such as the U.S., blah, 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 blah. How much electricity are these things generating? I get it. It's like super sustainable, obviously, because, there's always going to be waves. But how much energy are they going to generate? When you research a company like this, it's very interesting, but it's a very speculative investment. All right. Received the project pipeline is currently approximately 325 megawatts. I don't even understand that. I don't know anything about electricity. So, this is interesting. But, you go look at the financials and they're hot freaking garbage. No doubt. Let's see. Yeah, they're pre-revenue. They're not even earning freaking revenue. So they're just burning money on research and development and, paying their staff probably. So they got skyrocketing selling general administrative expenses. R&D is growing. Okay. Very immature company. Shares outstanding. They're going to have to issue shares. Man, look at those profit margins. Negative 117,000%. Pretty good. What do you think, guys? Pretty tempting. Balance sheet. All right, let's see how much cash they have. So they have $14 million of cash, and let's see how much cash they're burning. Let's see. They had $14 million of cash, and they're burning. Okay, they burned 1 million in that quarter, 180,000, 780,000, 600. Okay, they probably have a pretty significant amount of cash. Yeah, they can last for definitely a couple years, if assuming that cash burn rate continues. All right, so so operating cash flows negative 1.27 million. Acquisitions, they spent $120,000. What did they acquire? Like a freaking dock. So they're burning cash, but they're not going to go bankrupt anytime soon. I mean, I can't tell you that for certain, but just looking at this is a very speculative stock. So that's kind of my thoughts. I mean, interesting concept. If it works out, great. But does everybody want freaking boats just slapping around all the time? All right, let's see. What's our next suggestion? Airbnb. Airbnb. Let's see. What does Airbnb do? I wonder. Operates a platform that enables hosts to offer stays and experiences to guests worldwide. So it basically connects hosts to guests. So, I mean, this is not a traditional, hotel company, obviously. How does Airbnb make money? The majority of its revenue comes from service fees from bookings charged to both guests and hosts. Let's see how fast the travel industry is going to grow. How fast will the travel industry grow? Revenue in the travel and tourism market is projected to reach blah, 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 blah. It's expected to grow at 10.47% per year. I mean, I guess that makes sense as the world becomes wealthier, especially in places like China. People are going to freaking travel, even India. So obviously, I'm sure the travel industry is going to be doing fine. Temporarily with this big downturn, I don't know if a lot of people are going to be traveling. I mean, me and my wife even talked about going to like this park in Richmond, hour and a half down the road. And I was like, honey, we have to take our Chrysler and drive an hour and a half with almost $5 gas prices. We ain't traveling. So with gas prices like this, I expect travel to freaking plunge. So in the near term, you're not, Airbnb might have some trouble. I wonder if it's sold off a lot recently. Let's see. It's actually 172 to 121. I mean, it's sold off like everything else, but that ain't that bad, I guess. Let's go look at the financials. All right, so we got steadily growing revenue avenue, of course, except for 2020, because you know what. So they're growing fast as heck. I mean, it looks like they had this massive explosion in 2021. Of course, that's because everybody was locked down in 2020. So I would not use 77% growth rate. I mean, conservative estimates, I would maybe use, 15% revenue growth. Let's see if Airbnb had forward guidance. Airbnb stock forward guidance. Did they give any guidance? Airbnb stock was ready to take off with summer travel. All right, so let's read this article. Get out of here. Airbnb reported blockbuster first quarter results as travel rebounds. Okay. They also just redesigned its platform and app, making several notable improvements. And it's down 36%. Okay, let's see what they actually did. Revenge travel. The forward guidance issued by Airbnb was equally strong, with the company telegraphing that it now expects second quarter revenue between $2.03 billion and $2.13 billion, which is better than the average analyst estimate, which would be a 52% annualized growth. So I guess if that, is that from the last year? Let's see. So if the second quarter was, we'll call it $2.1 billion. What did they have in the second quarter before? Let's see. Wow. Yeah. So their second quarter in 2021 was $1.3 billion. And they're saying they're going to get $2.1 billion here. Well, let's get rid of this. $2.1 billion. So that's a growth rate of 2.1 divided by 1.33. Yeah, 57%. Look at that. The math almost checks out there. So they're Airbnb is probably going to, potentially experience explosive growth, or they're going to have a nice year this year, maybe. But then again, gas prices may affect that. So you might want to factor that into your calculations. But overall, I think this company will continue to grow. Let's go look at the earnings. Are they actually profitable? I know nobody cares about that, but are they actually profitable? Looks like they're unprofitable. They have operating income at least. Okay, at least they have positive operating income in 2021. Have they had any profitable quarters? Let's see. Net income by Schlum. So, okay. Let's see. Yeah, I mean, it looks like the quarter ended September 30th, for both years. That's where it looks like they get profit. So I guess people travel a lot in the summer. I don't know. I just travel when I can. I don't know if there's like a seasonal, time where people travel. Let's go see when people are most likely to travel. When are people most likely traveling? Doesn't even freaking say. When is travel season? You can roughly say that peak season is summer, which is June through August. Okay, so Airbnb is going to, of course, it makes sense because you look at their quarter ended September 30th for every year. They posted a profit margin, so it's going to go up and down, up and down, up and down. It's very cyclical and predictable. So if you wanted to model out their earnings, I mean, they're still unprofitable mostly, but if you wanted to model that out, you definitely want to take into account that your profits, you're only going to get those maybe at a certain quarter of the year. Let's see. Are they issuing shares? Yes, they are. Nothing insane, but they're definitely issuing shares. Let's see if they have free cash flow margin. Man, they got some crazy free cash flow. Look at that. Woo! Let's look at the balance sheet. My balance sheet. Let's see. Okay. Current ratio. Total current liabilities, $9.7 billion, of which $1.7 billion is deferred revenue. Now, I don't worry about deferred revenue too much. Usually when people pay in advance, that's deferred revenue. Now, unless there's like mass cancellations and they have to pay people back, like during the pandemic, that's when you have to worry about it. But in general, if the economy doesn't completely go sour, deferred revenue, they just got cash up front. So they're most likely going to recognize that revenue. So it's not a liability, like something they have to pay. It's just a service they have to provide, which their service is just connecting vendors to travelers. So I don't really stress about deferred revenue too much, unless it's an industry where people are prone to cancellations if the economy tanks. So overall, it seems like they're in a decent cash position. I mean, they got $9.3 billion in cash, $6 billion in receivables. Yeah, I don't think they're going bankrupt anytime soon. Now, they don't really have a lot of property, plant, equipment, goodwill, or long-term assets. So it's not a very capital-intensive industry, which I guess makes sense because their job is to freaking connect people. I mean, how many buildings do they need? So that's a good thing. That's probably a positive thing for profitability. They don't have to pay a lot of overhead for freaking buildings and factories, obviously, or like a hotel, all the freaking overhead that goes with that. What is their gross margin? Yeah, look at those gross margins, man. This company could be a freaking powerhouse. So apparently there's something in the operating margin that's really expensive. It's costing them a lot of money. See, the one thing I don't like about this website is it doesn't go into super detail. You actually have to go look at the 10K probably. But you can see their biggest expenses are selling, general administrative expenses. That's normal. And research and development. Now, my question is, what are they spending on R&D? I mean, just making their app sexy? I mean, do they really need to spend $362 million on that? I mean, nothing crazy, but it's a lot of money, So if they were going to slash something, I would imagine they would slash it there. Let's go look at their cash flow. All right. They have positive operating cash flow every single quarter, at least since the end of 2020, which makes sense. Nothing wrong with that. And it's growing. Okay. Let's see. Investing. What are they buying? They don't really have a lot of capital expenditures. They don't have a lot of depreciation, obviously, because they're not very capital intensive. Changes in investment. So really no crazy investments. I don't even see an acquisition here. They're not really acquiring anything. They are issuing shares. The question is what for? I mean, they seem to be generating a pretty healthy amount of cash from their operations. So overall, I would be interested in Airbnb. Let's see what the if there was a massive sell-off. PE ratio 94. I mean, that's pretty steep. That's pretty freaking steep. I mean, I get it's a high margin industry and it's growing, but that's pretty expensive. I don't know. That's the kind of PE ratio that turns me off. That's like Tesla's PE ratio. Price to free cash flow 27. I don't know. So let's go back and look. Let's go back and look at their margins one more time. So free cash flow margin is extremely high. Profit margin is extremely low. There's got to be some kind of non-cash expense in there. Share-based compensation. Okay, or maybe just changes in working capital. It doesn't seem too bad. And another reason they don't have a lot of free cash flow or a lot of free cash flow is because they don't really have a lot of capital expenditures. I mean, what do they have to expend money on? So overall, I wouldn't touch a stock like this right now. I would probably wait a little bit and see how this whole recession thing shakes out. And if this stock gets freaking wrecked, if there's a really bad recession and this stock gets freaking wrecked, there may be some potential here. So, I mean, not bad, but not perfect either. All right. SoFi and Lucid. I've done SoFi a couple times. We'll go look at Lucid. Lucid. Lucid by Boosted. Let me guess. Highly unprofitable. There's two Lucids. All right, what does Lucid do? Lucid, they sell highly expensive cars. Develops EVs. Let's go look at Lucid cars. This is the amount of DD I do. Lucid cars. I just buy index funds, you know what I'm saying? Oh, you see that? Luxury electric cars. I wonder if Tesla says luxury electric cars. Let's see. Tesla cars. Do they say luxury anywhere? Luxury. Oh, nothing luxury. Interesting. Even though they charge out the butt. So Lucid is in the luxury car market. I mean, how big can you freaking grow? I've already talked about the luxury car market. Let's go look. Size of the luxury car market. So the whole market generates $449 billion, or it did in 2019, and is expected to grow at a compounded annual growth rate of 9.3%. Now, let's see if they actually have like specific auto manufacturers here. There's a lot of freaking cars, a lot of companies competing in the luxury car market. So it's still a highly competitive industry. And you can see the amount of freaking electric cars that are getting pumped out. Now, my question is, what's so special about a Lucid? I mean, it's cool. Oh, look at that. It's so sexy. I mean, it's got great range starting from $87,000. Jesus Christ. The Grand Touring. Oh, yeah, baby. They have an SUV. The Air Touring. Oh, only $107,000. The Air Pure, $87,000. The Air Dream, $169,000. Reservations closed. Wow. Interesting. 154, 107. Holy freaking crap. All right. Let's go see. Okay, so they have a market cap of $31 billion. I can tell you right off the bat, that's overvalued. Massively overvalued. What is Ford's market cap? Ford. So Ford's market cap, and they make millions of cars that people can actually afford, is $54 billion. Lucid's market cap, $31 billion. This thing's still in a massive freaking bubble. Look how high it went. It went up to $55. What? Was this almost $100 billion market cap at one point? This is nuts. Oh, that's not a bubble, bro. All right, let's see what their gross profits are. They don't even have positive gross margin. I mean, they could potentially have high gross margins. I don't really know that much about the company, but this is just unprofitable garbage. Like, who would speculate on this stock? I mean, yeah, they have growing revenue, my avenue, and okay, electric cars are exciting, but look at the share issuance, man. Look at that. Well, I don't know what the heck's going on here, but I can guarantee you they're issuing shares. Let's see, cash flow. Negative operating cash flow getting worse. capital expenditures going up. So you're not going to have any free cash flow for a long time. This is highly speculative trash. Price to sales 375. 375. Seriously? At least Tesla's cars are somewhat affordable. This is ridiculous. This is garbage. This does not get my stamp of approval. Let's see. Airbnb. Please do. I did Wave. Are you actually buying Wave? I mean, I guess for a speculative investment, sure. It seems interesting, but I mean, I'm not against the concept, but I don't know crap about that. Strong man, do hims and hers. Hims by Schlims. All right, let's go look at hims. Let's go look at hims. Him stock. Let's look at it. Let's stay consistent. We'll look at it here. So I remember what was that idiot's name? George Perez Lopez. I always mix him up. It's like there's a comedian and there's this clown on YouTube. Let me look him up real quick. I'll show you what I'm talking about. George Perez Hims. Yeah, there he is. The first video that pops up is mine. But here he is. He's a freak. This guy's a freaking loser. So he pumped out a ton of videos saying like Cardano was going to 10x, and you know how that went. And now he has this Discord where, you know, he probably makes a freaking fortune. But he was talking about hims, and I looked at it. I remember looking at it a while back, and it was garbage. Yeah, so if a guy like this was supporting hims, I can tell you it's probably in a freaking bubble. 88 to 25x. It's down like what? Probably 50% or more. Neo to 300. It's what, $18 now? This is the kind of guy that gets paid the big bucks on YouTube. Life just isn't fair, ladies and gentlemen. All right, let's go look. Overview. Hims and Hers operates a multi-specialty telehealth platform. Never heard of that before. That connects consumers to licensed healthcare professionals. The company offers a range of health and wellness products and services available to purchases. Let's go on their website and see what they have. Hims. They have some butt plugs I can try out. Telehealth for healthy, handsome you. They called me handsome. Oh, erectile dysfunction? I could use that. Hair loss? Some people say I'm bald. Depression and anxiety? I have a lot of that from watching YouTube. Premature ejaculation? Skincare? What kind of man needs skincare? Custom skincare starting at $29 per month. How much is the, how do they make money? Is it like a subscription, or it's just like a, you know, like you go talk to a therapist and they tell you, hey, take the Hims ED pills. Let's see. Oh, am I getting a consultation right now? I'm not doing this. Let's see. Okay, trusted by over 500,000. Okay, so it's a subscription. Let's see what they actually explore treatments. Yeah, let's do premature ejaculation. Start my free visit. Okay, why do I have to go through this? Like, I want to see how much this crap freaking costs. Okay, anyway, so it looks like they provide, you know, they obviously you do telehealth, and then you can just buy a bunch of products to treat your PP problems. So their market cap is $816 million. Their revenue, my avenue, is $320 million. Their net income, negative $72 million. Man, that's very appealing to me. Let's go look at the financials. Financials. Okay, so we got consistent revenue, my avenue growth. The last quarter alone, they made $101 million in revenue. Pretty high gross margin, it looks like. Very high gross margin. Okay. But of course, they have high selling, general, and administrative expenses. Now, the question is, what are these? This website does not give that much detail. Share dilution, my solution. It looks like they had some pretty massive ramp ups in the quarter ended March 31st, 2021. But it's kind of slowed down. I mean, they're still issuing shares, obviously, but it doesn't seem as bad. Let's go look at their cash flow. Let's see. So they have negative net income. They add back depreciation, share-based compensation, and other operating activities. That's got to be changes in working capital. like, oh, your accounts payable went down, so that's a subtraction, et cetera, et cetera. I could actually do a video about how you would look at a statement of cash flows. But I mean, looking at it, okay, they have negative operating cash flow, so they're burning money. They're going to have to raise capital somehow. Not really a lot of capital expenditures. I mean, if they're a website, a website and a warehouse, maybe. Share issuance, okay, other financing activities. So basically, there's this unprofitable company that sells you a bunch of dick pills, but it's pretty cheap. I mean, relative to some of the clown stocks out there, price to sales at 2.5, price to books 2.5. Let's see if they have a lot of goodwill on their balance sheet. Ooh, out of their total long-term assets, they have $135 million of goodwill. Remember what happened to Teladoc, ladies and gentlemen? That's right. Let's see, their total current liabilities is 48 million. All right, yeah, they're not going out of business anytime soon. Wait a minute. Okay, so they have roughly $200 million in cash and cash equivalents. Yeah, I think they're going to be fine. I don't think they're going to go out of business. But I mean, you look at the company, like, what is there to like about this? What's the moat of this company? Telehealth. You know how many freaking competitors are going to be out there with telehealth? Negative free cash flow margin, negative profit margin, and increasing. The only positive thing is they have high gross margin and they have growing revenue, but it's highly speculative. I mean, what's so special about this company? So I wouldn't buy that trash. Let's see. Check NTR trading at, I don't use forward PE. That's a little foo-foo. Money printing machine, NTR. Let's go look. NTR, my schlar, Nutrien. Woo, it's a pretty big company. $49 billion market cap. Revenue, my avenue of $30 billion. Oh, they're profitable. Look at that. Provides crop inputs and services. It offers potash, nitrogen, phosphate, and financial solutions. They distribute crop nutrients, crop protection products, seeds to 2,000 retail locations in the US, Canada, South America, and Australia. So they're globally diversified. That's good. And they're headquartered in Saskatoon, Canada. Let's go look them up real quick. Nutrien. I mean, I don't understand the farm industry that well. Transforming agriculture. All right, but the year throw in to make key, blah, 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 blah. What we do. Overview. We produce and distribute over 27 million tons of, what is potash? Okay, what is potash? It doesn't even say what it is. Potash, retail, potash. Okay, so I mean, they probably supply like crap to help crops grow. So, I mean, it's an interesting company. At least it's profitable. Let's go look at their financial ratios real quick. See if they're expensive. PE of 11, price to sales of 1, price to book of 2, price to free cash flow of 23. It's a little expensive, but nothing crazy. Debt to free cash flow. They do have a decent amount of debt. Look at that. Look at their debt to free cash flow. It's just over 5. So it would take them 5 years to pay off all their debt. Let's look at their returns on equity, assets, return on invested capital. It seems like they really improved their margins in the last year or so. I guess 2020 wasn't a good year. I wonder why. All right, let's go look at their income statement. All right, they had a massive explosion in revenue in 2017. Why do they have that? Let's go look. Okay. Yeah, they had a massive acquisition. Look at this. Oh, wait, no. Hold on a minute. That's a sale. Are these numbers jacked up? This shows that they divested, it looks like, because they got $5.4 billion of cash inflow from an acquisition. So was that some kind of massive divestiture? Let's go look. Nutrien divestiture. Did I spell that right? 2018. I'm like a foo-foo here. I can't freaking spell correctly. See, the company divested its equity interest in the investment in ICL. What is ICL? Global Fat Manufacturer of Specialty Minerals. Okay. So, but it looks like they have pretty solid revenue. I mean, pretty consistent revenue. They had 19 million or 19 billion, 20 billion, 20 billion, 27 billion. I guess that's probably due to inflation. I mean, everything's going up in cost. But that doesn't seem like it's a consistent type of revenue growth. So, I mean, I could put this into my analytics tool. Let's go ahead and do that real quick. I'm pulling these numbers out of my butt, by the way. So don't be like, oh, I'm buying the stock because Strongman said to buy it. I mean, I literally know next to nothing about this company except it provides seeds, basically. Seeds and farts. So, let's do the trailing 12 month. So, trailing 12-month revenue would actually be $30 billion times 10 to the sixth power. The equal sign in there. All right, shares outstanding. How many shares do they have outstanding? 500. Oh, are they buying back shares? That's cute. They're buying back shares. I like that. 555 million shares. 555 Okay. Discount rate. We'll do a 10% return. Match the market. Revenue by avenue growth. Now, this is tough because I don't really know jack about this industry, but you can see their revenue has been pretty freaking. Let's see. Hold on. Let's look at their annual revenue. Flat for 3 years and then a massive spike. Do they have an acquisition in 2021 or is that just because of inflation? No, they didn't really. Yeah, that's got to be due to inflation. So, I mean, sure, if inflation keeps up, I'm sure their revenue will, keep growing. But that seems that's a pretty extreme amount of growth right there. I mean, 32% revenue growth for a company like this that was growing at 2 to 4%. I would use 3% revenue growth for this company just to be conservative. Let's look at their profit margin. Let's see. Yeah, look at their historical. Their margins are all over the place. 18, 4, 2.2, 11.38. That's probably because of inflation. I'd probably use 4%, avoid a crazy year. So that's actually, we'll do 4.5 to be nice. Free cash flow margin. Okay, seems pretty consistent. I guess they had a lot of capital expenditures maybe in 2018. We'll use 8. Why not? What's their PE ratio? 11. 11-7. We'll use we'll use a disposition 12. 12. And are they doing buybacks? I saw it looks like they had 1 quarter of buybacks. Let's see. Okay, so they paid off debt. They bought some shares back. I think it shows you their buyback yield. Where's it at? Buyback yield. We'll say they buy back 2% per year. Okay. What's their stock price rate? Woo! Well, that don't look that great, ladies and gentlemen. So, I didn't even update my free cat. Yeah, I did. I mean, I don't know. I mean, I guess if they had much faster revenue growth, like let's say inflation stays at 8%. I don't know. I think the market's valuing it so richly because they had that. This is one of those companies that massively benefited from inflation. It's like a staple. I mean, but it doesn't seem like it's, that great of a deal if you use very conservative assumptions. I don't know. I mean, look at that revenue growth. 2%, 4%, 32%. That doesn't seem natural to me. I think revenue growth would potentially be flat going forward into the future, or maybe, growing very slowly. Yeah, it had a massive run up. Look at that run up, man. It was trading at, oh, look at that. See my assumption there, 35. And right when the pandemic started, it was like 27. And it had a massive run up. This stock seems dangerous. I don't know. When I see a stock run up like this, and you look at its past growth, and a lot of the benefit comes from probably inflation, that's pretty scary. I wouldn't touch that stock. That's my personal opinion. Let's see. Okay. Vestas Wind Systems. Holy crap. How long can I do this? Vestas. Vesta. Not even popping up. Sorry, buddy. I love you, but let's see if we can find something else. VSBY. VSBY. It's not popping up either. What are these like micro cap trash stocks? What is this? Let's see. Trying to find some interesting ones here. I thought I saw me Kevin for a second. I was like, ooh, you gonna give me a super chat, bro? I mean, yeah, the stock ran up and they're benefiting from inflation. That's what it looks like to me. But when a stock grows that quickly, that scares me. It's like, no, I'm gonna sit back and wait. Let's see. Airbnb, we did that. Let's see. Altria, boring. Let's see. Are you bulked or fat? I'm jacked and sexy. What do you think? Is debt issued counted in free cash flow? Issued debt should be, well, I guess it depends on the type of free cash flow you're using. The formula that I use, no, it's just operating cash flow minus capital expenditures. Debt issued would be under financing activities. That's you're borrowing money, you're financing your company by issuing debt. So from what I use, and I'm not a financial expert, I think there are multiple ways you can use, factor in debt, but I don't do that with mine. I have a very ghetto model. Let's see. Square. Actually, I think I saw one that was interesting. Zoom. Where's my Zoom boy at? Zoom, my phone. Room. Let's go look at Zoomy. Zoom video communications. Oh, so right off the bat, I can tell you, I would not touch this stock. Why? How hard is it to make a freaking platform where you can have meetings on the internet? I mean, basically every freaking website has this. Now, they've had massive revenue growth. I mean, like, holy freaking crap. But there's tons of competition out there. $34 billion market cap, revenue, $4 billion. So it's a price to sales of what, like 8.5? Net income, they are profitable. That's good. Ugh. What does Zoom do? They provide unified communications platform around the world. They have Zoom meetings that offers HD video. They have video, voice chat, content sharing. Wow, that's so original and unique. Let's go look at some of their ratios. All right, so you can see their market cap in 2020 went up to $106 billion. Holy freaking crap. And now it's got cut down almost 70 freaking percent to a market cap of $34 billion. This company's been freaking wrecked. PE ratio is 27. I mean, if it's growing pretty quickly, that might not be too rich. Price to sales, 8. Price to books, 5. I wonder if they have a lot of goodwill. Price to free cash flow, doesn't seem that bad, but we got to look in more detail. No freaking debt. Very high return on invested capital. Let's go look at the income statement. So, like I said, they've had massive freaking revenue growth. I mean, that's insane. I mean, they went from $622 million in 2019 to $4 billion. That's a lot of freaking money, $4.1 billion. But I mean, how fast is that going to continue into the future? So you can see the revenue growth is already starting to slow down. Look at the massive explosion during the pandemic year over year when we had lockdowns. And then look how the year-over-year growth is really starting to decrease every single freaking quarter. 53, 35, 21, 12. It's slowing down pretty significantly. So going forward, they might not have crazy revenue growth. Let's see. What if the Zoom's management has given guidance? Zoom management. Zoom stock management forward guidance. How fast are they going to grow? Zoom Video Communications reports fourth quarter and fiscal year 2022. Your number of customers is up 66%. Fourth quarter revenue is $1.07 billion, up 21%. What is their forward guidance? Let's see. Total revenue up 55%. Financial outlook. Zoom is providing the following guidance for its first quarter of the fiscal year 2023 and the full fiscal year of 2023. Let's look at the full year. Total revenue is expected to be between 4.5 billion and 4.5 billion. And then full year non-GAAP diluted earnings per share. Why are we using non-GAAP here? So that's kind of annoying. So if their revenue for 2023 is going to be 4.5, let's go look and see what their revenue was for 2022. Well, we don't really know. So look at that. So 2021, their revenue was $4 billion. And then you go look here, they're saying their revenue is going to be $4.5 billion. So their growth is massively slowing down. At least that's what it looks like on the surface. Like I said, this data might be all convoluted and jacked up, but they're definitely slowing down. You can see that right here on the quarterly growth. I mean, look at that. 35, 21, 12. Let's go look at their actual margins. Let's see. Gross margin. It's been improving. That's a pretty high gross margin. Operating margin, I would use the more recent year or recent quarters. I wouldn't use the crap during the pandemic because that's just a crazy one-off. Look at their most recent profit margin, 10%. But it looks like they're hovering around 28, 25, 29, 23, 31, 32, 45, 10. So I don't know. Maybe I'd say their profit margin going forward would be 23, 24%. They have a much higher free cash flow margin, so they must have a lot of non-cash expenses or not a lot of capital expenditures. Let's go look. Let's see. Share-based compensation increasing. So they were unprofitable. It looks like their last quarter. Well, hold on a minute. No, they were profitable. But a huge part of their add back for cash flows is share-based compensation. How fast are their shares outstanding growing? Let's see. There should be I like how they have like the buyback yield. Yeah, look at this. Let's do annual. So their dilution has slowed down a lot. You can see, look at their share dilution. I guess they went, when did they go public? But you can see they were issuing a ton of shares. They issued a crap ton in 2020. I guess that makes sense. And in 2021, they only issued 2%. And in 2022, they issued basically no shares. I mean, we could do like a ghetto projection. I mean, we could say $4.2 billion. Yeah, so they're trailing 12 months. Okay. Let's just say, let's do a ghetto analysis here. Like I said, a lot of this stuff I haven't done a ton of research into. But I can tell you there's a lot of competition in this industry. And I think Zoom was a massive beneficiary of the pandemic. And a lot of people bought into Zoom because, oh, it's just going to go to the moon forever. Yeah, okay. All right, so let's see what else we have here. Shares outstanding. 307 million. Discount rate, we'll say 10%. Revenue growth, I'm going to say they're not going to grow fast. Maybe like, we'll say they're going to grow the normal pace of inflation, 3%. Profit margin, let's see. Okay, we'll call it 25. The cash flow margin, looks like it's dropping. I don't know if they're doing a lot of capital expenditures. We'll say 35. PE, I mean, if they're not growing that fast, what's their PE right now? 27. I mean, maybe 17. The price to free cash flow. 22. That's their price to free cash flow is lower than their PE. We'll just do 20 and then no buybacks. So, according to this ghetto model, if their revenue stays flat or barely grows, it's a buy at 56. Now, if their revenue starts to trend negative because they had a massive explosion during the pandemic and they have lots of competition, okay. So maybe I would consider looking at this stock in the 40s. You know, it's something to reconsider. I mean, they're not diluting that bad. They are profitable, but let's go look at the stock chart. Hello? There we go. Is my freaking internet going bad? Yeah, look at this. Holy freaking crap, man. I mean, they're already trading pretty richly before the pandemic. Look at that. $73, massive spike, and then massive dump. So honestly, just on the surface, right now it's probably still massively overvalued, but I don't know. Sometimes markets can be stupid. So that's kind of my thoughts on Zoom, my Zoom. Let's see. Thank you. Thank you very much. I did hymns. People could posting hymns in the comments. Airbnb. Look at Smith and Weston. I don't like Smith and Weston. That's just like a political gambling stock. Let's see what else we have on here. Ticker symbol, ticker RU. Smith and Wesson is lame. AERC. What is this? AERC. Aero Clean Technologies. What is this? An interior space air purification technology company. It provides air purification solutions for hospitals and other healthcare facilities. Air sterilization and disinfection, including, okay. They have 7 employees. Oh, look at this. Market cap, 161 million. Revenue by Avenue. Is that 616,000? Okay, this is another speculative stock. I mean, yeah, I didn't make that much, but I mean, Jeremy LaFufu probably makes more than this company. Yeah, come on, guys. This is just like speculative crap. They probably started this company during the pandemic. When did they start the company? Well, I mean, I guess they started in 2019. But they're like, oh, we're going to save the world. We're going to purify the hospitals. I mean, look at this. $161 million market cap on $616,000 of revenue. What's that price to sales? 258. This is just like speculative trash. Look at their margins. Like, what's so special about this company? I mean, is air purification like a disruptive technology? Does this company have like a special thing they do that's going to change the world? That's just a speculative stock. I wouldn't touch that. Sorry there, Drew. I know you're going to be pissed. Let's see. D-Dog. What is that? Let's see. My comments keep like the freaking comments keep like jumping around. Coke. That's lame. Neo. I just did that. Rick. Let's do Rick. Let's do the strip club. Let's do Rick. Shivers. So, RCI Hospitality Holdings, through its subsidiaries, engages in the hospitality and related businesses in the United States. Ooh. It operates through nightclubs, bombshells, and other segments. So it's a sin stock. Upscale adult nightclubs. I mean, I can tell you about nightclubs, man, or not even like strip clubs. So back in the day when I was in the Army, there were a couple strip clubs, and they were all garbage. I mean, there was one that was okay. This was in Fort Hood, Texas. It's called the Dollhouse. But we would go there, and they were such a scam that, like, let's say you needed cash, right, to give the stripper money. The freaking ATMs charged like $6 for a withdrawal. I was like, what? What? $6? Like, they were fleecing me. And that was back in like 2015. So strip clubs make a lot of money, man. Let's see. Blah, 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 blah. How many employees do they have? Pretty significant. I wonder if they count the strippers as employees. And it IPO'd in 1995. Okay. So very low market cap. 531 million. Revenue by Avenue. Okay, they're actually profitable. Let's see. Let's look at their financials. So let's go all the way back to 2015. 135, 134, 144, 165, 181, 132, 195. So basically, they were growing, 7%, 8%, 9%, 14%. Then the pandemic happened. Then it drops off a cliff, obviously. And then it overcompensates and shoots back up. But you can see like this almost looks like a natural rate of growth going from 195 to 181 over the course of 2 years. So I would definitely say they're going to have revenue growth. You know, strip clubs are freaking inflation resistant. You know, people get desperate, they just go to the strip club. Gross margin. Woo! They're making a fortune off of these strippers. I mean, do they own the real estate? I mean, like, what is their primary form of income? Let's see. Rick's. RCI Hospitality Holdings. Okay, they own and operate. Ooh, mama. Let's see. Look at all this. I actually went to a strip club up in DC, and we went there like in the middle of the day. It was like a work trip for NASA a couple years ago, and we go in there, and they're like, "Hey, Hunter Biden used to come in here." It was like this crappy strip club. The only reason we found it was literally attached to our hotel. I didn't plan that at all. And we go in there, and I was like, maybe I'll get my friend a lap dance. You know, I'm married. I wouldn't do that. But I was like, hey, let me get my friend a lap dance. So the stripper comes up. She's like, well, it's $100. Okay, number one. And number two, we can't take off our bras. It's like, what? What is this? Is a freaking disaster. So we freaking left. We actually had lunch there, and then we left. So, okay. Interesting company. So their revenue is going to grow. We'll assume that. We'll actually put this into a ghetto model. Looks like they're buying back shares. I like that. Net income, profitable. Let's go look at their profit margin. 15, 11, 12, 5, 8, 6. Why is there such an increase in profit starting in 2018? That's interesting. It looks like there was some kind of positive improvement because they kept their margins pretty good. You know, 12, 11, and 15. Free cash flow margin. I mean, that's all over the place. I'll probably just use GAAP earnings for this. Let's plug this into our model, okay? Just like a ghetto model. But before we do that, let's look at the ratios. PE of 14. I mean, seems reasonable for its growth rate. Price to sales 2. Price to free cash flow 16. That seems okay. Debt to free cash flow. They got a significant amount of debt. It would take them 6.7 years to pay off their debt. Let's go look at their balance sheet. Do they have a lot of property, plant, and equipment? So they got $239 million of PP&E. And they have $224 million of long-term liabilities. So it looks like they haven't taken out a lot of long-term debt other than to purchase property, plant, and equipment. One thing that would worry me is if you see like really high long-term liabilities and then you go up under long-term assets, you don't really see a lot of PP&E. That's when it gets freaking scary because that's almost them borrowing money to pay for operating expenses. So they don't have a crazy amount of debt, especially relative to their PP&E. So that's really not worrying. They have a decent amount of goodwill and intangibles. Looks like they had an acquisition. They had some kind of acquisition and wow, this most recent 2 quarters. Okay. Let's look at the annual. When did they acquire something? Let's see. Acquisitions. Okay, I'm starting to think that some of this data is just jacked up here because it looks like they're divesting stuff. It looks like they divested in 2021 and 2020. Okay, whatever. We'll use GAAP earnings and we'll kind of get like a rough ghetto evaluation of how much this company's worth. So trailing 12 months revenue, 238. Okay, and that's in millions. So 330,000. Okay, shares outstanding 9.48 million. It looks like 948. Okay, let's see. Okay, and then we got discount rate. We'll use 10%. Revenue by revenue growth. Let's go ahead and say they grow at, we'll call it 6%. That's the discount rate. 6%. Profit margin, they've improved their margins over the last couple of years. Their margins were pretty crap all the way up to 2017. And then 2018, 2019, they improved them. I don't worry about that much, or I'm more confident in their margins staying this decent, at least on the surface, because the margins increased before the pandemic. Stuff that happened during the pandemic just completely like confuses the crap out of me. It makes me really worried because it just put everything in flux. So we could say their profit margin would be 11.5%. Let's see. I mean, strippers are pretty profitable. We're not going to use free cash flow. And then PE, we'll give them a PE of 15. And are they buying back shares? Let's see. Looks like they consistently are repurchasing shares. So their buyback yield, let's go look at the ratios. Buyback yield. Okay, this, what is wrong with this? Something ain't right here. We'll leave it at 0. So according to this, it's a buy at $48. So it's not too massively overvalued if you want a 10% rate of return. I would definitely look at more data because you want to do a lot more research, but this is not egregiously overvalued. Now, if you wanted a 15% rate of return, according to my ghetto analysis, you want to buy it at 40. So it's not crazy overvalued. It's at 56. Let's see how low it's gotten before. Wow. Look at that run up, man. Woo! Whoa! That's a little terrifying, to be honest. Yeah, I would probably look at this again in the low 40s and reconsider, maybe wait a couple more quarters. All right. There's your strip club stock. Are you happy, Julius? How much you got invested in there? All right. Let me do one more stock, and then I'm going to go because I have to take a piss. VTRS. VT? VTRS. Guiterrez. Market cap, 14 billion. Revenue. Wow, their price to sales is under 1. Net income. It's not a very profitable company. What do they do? They operate as a healthcare company worldwide. They're in 4 segments: developed markets, Greater China, Jans. What is that? Is that like something New Zealand? And emerging markets. It offers prescription drugs, generic drugs, active pharmaceuticals. So basically, it's a drug provider. So number one, you look at their, I didn't know we had this financial statements here. Oh, okay. I like these graphs. See this graph right here? I like this. So you look at it, it's not very profitable. I mean, look at the earnings. Like look at the revenue compared to earnings. And they've lost money the last 2 years. Why are they losing money the last 2 years? All right, let's go look at some of the metrics. Okay. Look at the PE. 617, negative 15, negative 12, 84. It's all over the place. Price to free cash flow. It's pretty cheap on a free cash flow basis. The question is, why? All right, let's go look back at income. So revenue by avenue growth. It looks like they had a pretty massive slowdown and then a massive explosion in 2021. What's going on with this company? Did they acquire something? Looks like they're divesting. All right, this website might be jacked up. I may have to use a different website because some of like the stuff I look at doesn't match. It doesn't make sense. Like they'll say, or their revenue increased massively, or they had a bunch of goodwill added to their balance sheet. And then I go look for an acquisition and it's showing cash coming in, which an acquisition, cash should be going out. Unless I guess you're like issuing shares to acquire. So revenue growth is all over the place. I mean, that's number one. That's kind of like hard to judge. Gross margins, they've been declining pretty consistently. Profit margin has been declining pretty consistently. So it looks like they look good on a free cash flow basis. So let's see why they have more free cash flow. They have a lot of depreciation. Very capital intensive. Look at that. Look at the add back to depreciation. $4.5 billion in 2021. Go look at their balance sheet. Let's see. Oh my God. Look at that goodwill. 38. I wonder if we can go look at their balance sheet. Guiterrez balance sheet. So I wonder if it's goodwill or if it's intangibles that makes it so high. They have a ton of intangible assets or goodwill. Let's see. 10K. They amended their 10K. Why'd you amend your 10K? Very interesting. Okay, let's go look at the balance sheet. Balance sheet. Holy crap. Don't they usually have links? Balance sheet. Oh my God. What a pain in the ass. Is this even the full freaking 10K? What is this? Some weird ass 10K. Let's go look. Hold on. Investors. Boop, 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 boop. Boop, 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 boop. Okay, where's the freaking 10K? Why is this so hard to find? Beatrice 10K. Annual report. Here we go. Ugh, this is going to be ugly. Let's see. Financial statements, page 148. Oh, God. See how much work you have to do just to analyze a freaking stock, or you can just buy an index? Where's the financial statements? What is all this crap? Subsidiaries. They got a ton of subsidiaries. It could be a lot of goodwill on there. Let's see. Oh, my God. This looks like the notes to the financial statements. Blah, blah, blah. Screw college. Why did you give me this stock? Even the freaking financial statements are a pain in the ass. Oh, I think I'm here. Okay. Yeah, they have a lot of intangible assets. So their goodwill is roughly, let's see, 12 divided by 54. Goodwill is roughly 20% of their assets. And then, so maybe they have a lot of patents or something. Yeah, intangible assets net. So they're amortizing them. I wonder what intangible assets they have. Yeah, it's probably a lot of drug patents. Okay. So that isn't actually as dangerous as I thought it was. If you see a ton of goodwill, which this website doesn't specify, it just says, oh, goodwill and intangibles, 38. Let's actually see if the math works out. So 38. Let's see if it actually adds up. Goodwill and intangibles. Yeah, they actually got it right. Surprising. So they have a lot of intangible assets, which is fine. You know, really depend because they're that's what they do. They make drugs. I don't know, guys. I don't really like this company. It's like all over the place. It's unprofitable. Its margins are trending down. Do they have a lot of debt? Debt to equity ratio. So it looks like their debt. They've roughly had the same amount of debt. Debt to free cash flow. Actually, it would take them 7 years to pay off their debt. Let's see their return percentages. Return on invested capital, return on assets, return on equities, all freaking garbage. This kind of stock doesn't interest me. I mean, I don't know. Maybe you guys would like it. All right. Any more comments? Lafufu says she did get 500 hours. Yeah, who has time to put 500 hours into one stock? Nobody does. This is why I buy index funds. Do more live streams like this. Well, I'm going back to work soon, so it ain't going to be possible. But all right, well, that was kind of it. That was me pulling a bunch of stock analysis out of my ass. But it was kind of fun. Anyway, that's it. Talk to you later. Cheers.